Hey everybody, just Mark Penazon here with Mortgage Connection, mortgage broker in Edmonton, Alberta. Hope you're having a great day. Let's get right into the charts. This monthly technical update, we're seeing a bit of a trend here month over month. So currently we can see the bond yields here ripping upwards. They've been ripping upwards for the last 3 months here. So last month they were trending downward before this most recent uptick. And then previous months, February's update, we can see the whole month of bond yields increasing. And then the month before that, which would have been your December 15th update, they're kind of chopping around, but still moving upwards. And you can see this trend line moving upward, which is not what we want to see here. We'll see what happens next month when I do my April 15th update. But at the moment, it looks like the fixed year rates, which the bond yields follow, are trending upwards. You can see that there's been no movement with the Bank of Canada overnight rate. No rate change since July of last year. And the Bank of Canada, once again, if we look at the most recent update, held rates here for the fifth consecutive meeting. And it looks like they're just going to hang around until that inflation number gets closer to 2%. And inflation here has dropped down to 2.9% from the last reading in end of January. So we're going to wait to see what the next results are. We need to get that number down to around 2%, sort of in this target range here. And then once it gets around 2%, then we'll see what happens with the fixed rates if they start coming down. And certainly variable rates will start coming down. If we look at the current forecasts for the overnight lending rate, which is at current 5%, one website here at WOWA believes that they're going to now see about 0.75% drop. So this is 0.75% drop from our current rate down to 4.25% by December. This projection has been pulled back from the previous projection from both WOWA and the Bank of Canada's website of 1% cut this year. So now we're a little bit more dovish on the rate cuts, as it seems like inflation has certainly been hanging around and not dissipating as quick as we'd like. So with the Bank of Canada, with inflation not dropping as quickly, we might see this rate just keep moving flat until we get into the summer months, which we're now projected to see the first cut in June. And that would be the first 0.25% cut. And of course, that only impacts variable rate mortgages. So without looking at anything else, let's look at the rates. So current interest rates, not filtering anything in, we're looking at 4.84% with some of our smaller lenders, Radius 4.88, 4.89 for RFA. You can see the banks are still over 5%, 5.09, 5.14. And this is for any mortgage. If we sort of fine tune it, if we're looking at insured only, so this is less than 20% down, this is where you're going to see those rates. If we're looking, however, at mortgages with, say, 20% down payment, we're closer to 5.09. Welcome our new lender, Neo Financial, to the Lender Spotlight platform. So 5.09, so not bad for 20% down, all the way up to 5.34. And if I look at all the lenders with 80% loan to value, sorry about that. Yeah, we're at 5.09 to 5.34. And then if we look at anything uninsured, so this would be rental properties, refinances, or anything over $1 million, with the exception of Manulife at 5%, we're at 5.5% and up from there. And obviously this varies between all the different terms and products. So lowest 1-year rate, we're around 6.6, lowest 2-year rate around 6%, lowest 3-year rate 5.14, that seems to be reasonable. Lowest 4-year rate 5.09, lowest 5-year rate is going to be all those low rates 4.88. And then I can even show you the 10-year, which is about 6-year. I don't imagine too many people are locking in there. And then variable rates, again, haven't moved. Still prime -1 are the two best offers here. Some lenders not very aggressive. Prime is 7.2. So ATB is only offering about 0.25% discount on their rate. TD and Scotia not very aggressive either, but there's certainly better offers to be had in the variable rate space. Okay, let's look at what's driving these numbers here. If we look at unemployment, obviously high unemployment would help push the bank to cut rates faster. Really not a lot of difference here. February numbers, 5.8% unemployment in Canada, a slight uptick from January, but really just kind of holding on. This isn't going to move the Bank of Canada to cut rates anytime soon. So we probably want to see unemployment start trending upward before the Bank of Canada makes any moves. Interesting thing here is the amount of employed people has been consistently growing. So this metric is probably a little bit skewed because of the immigration numbers into Canada. So more people immigrating, more people working, however, more or less the same number of people unemployed. And then there's the housing starts. So, how are we going to fix this housing bubble? Well, if you're immigrating a whole bunch of people, as Canada has been doing, record numbers in the G7, in fact, and we're not building more homes, that's going to keep pushing house prices upward. So we started a little more than last month in terms of housing starts. So about 253,000 units versus 223. But again, these numbers are all really low. We need to be trending upwards month over month, year over year to really start to see numbers improve. If you go back to 2015, when they were building around 193,000 homes, we're at like 230, 253. So, this isn't really a great number to look at. We're building more or less the same homes as we were in 1978, yet we have probably double the population. Not a good sign at all for home prices in the long term. Also, I wanted to point out one more sort of piece of news here that came out March 8th, about a week ago, from Mortgage Professionals Canada. There's been a surge in mortgage delinquencies. Equifax unveiled that there's a continuing trend of rising missed payments on mortgages and credit cards, particularly in Ontario and British Columbia during the fourth quarter of last year. This will encourage the Bank of Canada to cut rates sooner, specifically to help out those two major markets. You can see delinquency rates are up 135% in Ontario and 62% BC. So not a good sign at all in regards to mortgage delinquencies. So where do we go from here? Well, I think if you're looking to purchase a home in the next 4 months, you're going to probably want to lock into a fixed rate mortgage. You saw there around 5%. Maybe you lock in while we watch rates continue to move. More inflation data will come out between then. We heard the first rate cut may not be until June. So if the first rate cut is in June, which would be right around here, that would be probably in line with locking in a rate hold right now. So that's what I would do on the fixed rate. I'd probably lock in a fixed rate while you're shopping for a home and then see what the market does. And then as soon as we get that first rate cut, then I would be looking to possibly pivot into a variable rate mortgage, potentially watching that come down as it has in previous cycles. We've gone over this a number of different times. If we go to the monthly chart, you can see as inflation comes down, rates come down with it. Here's a better example here. In 2008, inflation went way down, and the red line, variable rates, came down with it. COVID, inflation went way down, and the red line came down with it. So we're pretty much going to be in that same category. Inflation has come down, and we're right about that tipping edge where rates are going to start coming down. So there you have it, this month's update. Thanks, everybody. Have yourself a great weekend. If you have any questions, feel free to reach out anytime. You can reach me at www.markpanazon.com. Take care.